Are you ready to invest smarter? You might think you're just a few clicks away from making a fortune in the stock market, but stop. What if I told you that you're about to step into dangerous economic waters that could cost you big? In today's video, we're uncovering the most dangerous economic warning signs that every investor must be watching for before you put your money in anything. You won't believe how easy it is to spot these signs and how many people miss them. Stay tuned to learn how you can protect yourself and make money even in a crisis. We've all heard the saying, money doesn't grow on trees. But what if you could make your money grow faster and smarter without all the risk? It's possible, but only if you know how to read the economic signs the market is giving you. Most investors are focused on chasing the next big stock or getting rich quick. But the truth is, timing is everything in investing. A major economic shift can take place overnight, and if you're not prepared, your investments can crash before you even blink. That's why today, we're going to dive deep into the economic warning signs that could completely change the way you invest. And these are the crucial indicators that could either make or break your portfolio in times of uncertainty. Inflation, the silent killer that slowly erodes your purchasing power. You might be thinking, what's the big deal? Prices go up, that's normal, right? Wrong. When inflation spikes, your money's value literally shrinks. A $1,000 investment today could be worth a lot less in the future. Take the 1970s oil crisis, when inflation hit the US hard. People with fixed incomes, like those relying on bonds or savings accounts, saw their wealth erode at lightning speed. The value of their savings fell while prices skyrocketed. You can't afford to ignore this silent thief of wealth. Flash forward to the 2020 to 2022 period. The world was hit by the COVID-19 pandemic, and inflation surged to a 40-year high. Those who hadn't accounted for this in their investment strategies saw their portfolios take a massive hit. Are you prepared for inflation's unpredictable effects? The best way to fight inflation? Invest in assets that traditionally outpace inflation, such as stocks, real estate, and commodities. Commodities are certain goods like precious metals, which tend to hold or increase their value during periods of inflation, protecting your money from losing purchasing power. If you're in the market for bonds, consider TIPS, Treasury Inflation-Protected Securities, to protect your investments. How have you been impacted by inflation? Have you made any changes to your investment strategy? Let us know. Yield curve inversion, the red flag of recessions. If you've never heard of the yield curve inversion, you're about to learn one of the most powerful recession indicators the market has ever seen. This isn't just some abstract financial term. A yield curve inversion is a warning that could signal an economic slowdown, or worse, a recession. Here's how it works. Normally, the longer you lend your money, the higher the interest rate should be. That's why long-term bonds usually have a higher yield than short-term ones. But when short-term rates surpass long-term rates, that's a red flag. It's happened right before every US recession since the 1950s. In 2007, before the 2008 financial crash, we saw an inversion. Smart investors who noticed this sign made adjustments to their portfolios. Those who ignored it were hit hard during the crash. If you spot a yield curve inversion, be proactive. Start moving into defensive stocks, such as those in utilities, consumer staples, and healthcare, which tend to do well in recessions. Rising unemployment, the hidden economic health check. When the unemployment rate begins to rise, it's often a sign that something is wrong with the economy. More unemployment means fewer people are spending, and less spending means lower demand for goods and services. This affects not only companies' bottom lines, but also stock prices. In 2008, during the financial crisis, US unemployment shot up to 10%. The economy came to a grinding halt, and the stock market plummeted. Those who were paying attention to job growth numbers and unemployment rates could have anticipated the downturn. Let's talk about the COVID-19 pandemic. As unemployment soared, the stock market had massive swings. Those who understood the correlation between unemployment and the market's health were able to adjust their strategies accordingly. If you see unemployment rising, it's time to tighten up your portfolio. Defensive stocks and dividend-paying stocks are a safer bet during these times. Healthcare stocks and discount retailers are known to hold up well when times get tough. Here's a big one. Stock market volatility. The emotional roller coaster. It can feel like riding a roller coaster with your money on the line. But what if I told you that market volatility doesn't have to be something that scares you? In fact, volatility can be a sign of opportunity, if you know how to manage it. Let's look at March 2020. The markets tanked due to COVID-19 fears, dropping over 30% in just weeks. But here's the kicker. If you'd bought the dip, you could have seen your investments skyrocket as the markets recovered. Those who panicked and sold missed out on the bounce back. When volatility strikes, don't panic. Consider dollar cost averaging. Dollar cost averaging, DCA, is an investment strategy that involves regularly investing a fixed amount of money into a specific investment or portfolio of investments, regardless of the asset's price. This strategy helps you buy low and sell high over the long term. Central bank policies, the power players behind the curtain. The central banks pull the strings behind the economy. When central banks raise interest rates, they're essentially saying, time to slow down the economy. This can be a huge red flag for investors because higher rates mean higher borrowing costs, which can lead to reduced consumer spending and slower economic growth. In the early 1980s, the Federal Reserve hiked rates to combat runaway inflation, leading to a recession. Also more recently, the 2018 Federal Reserve interest rate hikes caused significant market volatility, which some investors saw coming. If you're tracking the Fed's moves, you'll know when to adjust your portfolio. Higher interest rates tend to hurt growth stocks, so move into value stocks or even high-yield bonds during rate hikes. Global economic trends. The bigger picture. Let's zoom out and look at global economic trends and their impact on your investments. In today's world, events in one region can ripple through the entire financial system. Trade tensions between the US and China have led to market uncertainty. The IMF projects global economic growth to slow to 3.2% this year. This slowdown affects corporate earnings and commodity prices. Sustainable investing is gaining focus. Investors are considering ESG criteria. ESG stands for environmental, social, and governance factors which assess a business's long-term sustainability and ethical impact. Morningstar reports $20 billion in new sustainable assets this year, so spread your investments across various asset classes and geographies. Technological advancements, the game changers. Let's delve into how technological advancements affect market dynamics and investment opportunities. Innovations create both opportunities and risks for investors. AI is revolutionizing industries. From healthcare to finance, AI-driven solutions are unlocking new revenue streams. Blockchain is another game changer. Beyond cryptocurrencies, blockchain is used in supply chain management and secure voting systems. Renewable energy technologies are gaining traction. IoT is connecting devices, creating smarter homes and cities. With opportunities come risks. Stay informed and agile. Diversify your investments across tech sectors to mitigate risks and maximize gains. All right, let's wrap up. So these are some warning signs you need to be aware of to protect your investments. By keeping an eye on these key economic indicators, you'll be prepared for whatever the market throws your way. These aren't just abstract concepts, they're actionable strategies to protect and grow your wealth, no matter the state of the economy. If you found this video valuable, don't forget to like and subscribe for more tips that'll take your investing game to the next level. And ring that bell so you never miss out on our latest content. I want to know, what's the #1 warning sign you look out for in your investment strategy? Drop your thoughts in the comments below, and don't forget to make smarter investment decisions. Remember, understanding these indicators can help you navigate market volatility and make informed decisions. Stay informed, stay prepared, and happy investing.